You see the Fed not moving until the middle of the year. I think that sort of expresses perhaps this fluid consensus about when the rate cuts might begin.
Well, sure. And when you have unemployment sub 4%, you still have wage growth around 4%, and you have just a strong economy. This GDP number is unless it's a mistake that's going to be reevaluated and adjusted. This is not an economy that lends itself to a more accommodative Fed. Sure, the current rate at 5 3/8 is well above inflation and will come down, but I don't see how the Fed rushes to that, risks reigniting inflation when wage growth is well above, 2 times above their target rate of inflation. So that's why we think investors should delay their optimism for rate cuts till the summer.
All right. And when those rates happen, or in anticipation of them, you think REITs would be a target of opportunity. REITs in warehouse infrastructure, cell towers, apartments, really the whole panoply of REITs. The whole panoply, that's a great word, other than office. And that's what we think the stigma, the stain has been for a lot of investors. They think that REITs de facto have to have office, and that is not true. Host hotels in the luxury resort areas, it has no office exposure. Apartment REITs like Avallone, no relation, have no office exposure. The healthcare REITs have no exposure, and cell towers, as you mentioned. So investors, look, our favorite sector is technology, but you can't just, we're asset allocators, so we can't have everything in tech. So when we look on the value side, this is where we see strong cash flows, diversification, an opportunity for investors to receive current cash while interest rates come down, and those dividend yields will hopefully look very attractive. Let's talk about technology, because you have an interesting take on it that is intuitively very appealing to me. I like funds. I think you get instant diversification. I like the transaction costs with most funds, or the expense rates on most funds. You have 2 that you're suggesting that are so-called equal weight technology funds: JP Morgan Technology Leaders Strategy and First Trust NASDAQ 100 Tech Sector. Explain to me why the equal weight approach makes sense to you right now. Well, exactly. And when we look at if we look at a traditional tech ETF like the XLK, I don't think many investors would realize that 42% of their exposure is Apple and Microsoft. It's the same for the Fidelity and Vanguard information technology ETFs. And since those 2 names are such a big part of the triple Qs, such a big part of the SPY, Apple's in Berkshire Hathaway, you can't not own Apple, it seems. So then to own what you think is a diversified tech ETF and just layer more on, we feel adds risk to the typical investor. The 2 ETFs that you mentioned, they have about 42 names. They're roughly equal weight. They're structured a little differently. And we get to leverage the research departments of a great entity like JPM, get technology-enabled companies as well as technology companies, and really benefit from a broad base of companies that are either in the tech space or benefiting from it. And the multiples in those funds are even less than what you pay for the Magnificent Seven, which after Tesla's demise is really the Magnificent Six. So we're getting less expensive tech, broadly diversified, and we think that's a better way to play the tech game than the Magnificent Six. So